Welcome everyone to Name Confidential Live.
Hey everyone, welcome back to another week of Name Confidential. I'm your host, Branden DuCharme, coming from out in St. George, Utah. Today I am joined by a friend of mine, Shailesh Gupta from Simplify. And Shailesh is the Chief Investment Officer of Structural Alpha at Simplify. And it's what we're going to be talking about today. Like Shailesh, really quick, give us some insight into what is structural alpha, because when I think of alpha, it's elusive, right? Most people don't have it. It's really edge in the market. It's edge in some kind of trading system. It's your ability to pick the stock that performs better than the market, and certainly getting alpha on a risk adjusted basis is very tough. But it's obscure, and here you come saying, well, no, it's not elusive, it's structural, and you can just observe it and find it and identify it and take advantage of it.
Yeah, Brandon, I mean, you can think of it in terms of like swimming upstream or downstream. So, you are trading in the market, your position in the market, but the structure of the portfolio could be such that the stream is in favor or against, so to say. And these, like little small effects, add over time. And because of that, I have seen from my experience at PIMCO that these kind of the considerations add value to the portfolio. That's how you can outperform on a consistent basis over several decades for that matter.
So is structural alpha more about capturing alpha in a structural manner over entire market cycles, a daily basis, a mixture of both? I mean, what's the expectation that people should sort of have when we have this conversation?
I mean, the effect is always there, but typically the results show up on a 3 to 1 year kind of horizon.
Okay.
Usually over a 1 hour horizon, you can see, the effect. And, we can probably get into some examples to understand, how, it works. Most of it is available in the bond market. That's why you see more active managers outperforming the benchmark in the bond market as compared to the equity market. But sometimes it is very visible in the equity market as well. So why don't we just pick up an example and talk through it so we know what we are talking about here.
Sure.
Okay, so let me share my screen here. Okay, so this is the bond market, but we are going to start our discussion with the stock market. So one of the popular strategies in the stock market is the covered call strategy, right? So we know a bunch of covered call strategies, started very generic, buy right, strategies, and
Mm-hmm.
CBOE has index, and there are a bunch of ETFs. Total AUM of these popular ETFs, over $90 billion. So when such large amount of assets are deployed to a strategy, so in this strategy particularly, investors are looking to kind of structure the beta exposure in such a way that it meets their say yield demand, right? So there is a demand from investors to collect yield. So that's why this beta has been structured through a covered call strategy. But actually, while trading in the market, the fund managers would have to sell these options, right? So these that would create structural flows of option selling in the market. And the market maker would need to hedge these positions and provide a price. And the price would be such that ultimately the market maker needs to make money, right? So they should be able to make money. Then only that's the price they will give. That if the market maker is not making enough money, then they will obviously reduce the price and so on and so forth. So effect of that price, one can see that over last 10 years, this brown line is US large cap equities, basically S&P 500. And this is just the buy right call index from the CBOE. We see significant underperformance. And the buy right index is basically S&P 500 exposure. Against that, they're selling call options, right? So effectively, the call options have lost this much money, or on an annualized basis, stock market over this period has grown at the rate of around 15%, while the covered call strategy has made only 7%.
Mm-hmm.
So around 8% or so has been the drag, from the options. So if one had put in only the option position without the stock, then those option positions would have lost around 8%, right?
Okay.
So, like that is kind of, the amount of charge which the market makers are kind of, putting onto that strategy. So, to take advantage of this, investors who do not have the need for income but have a need for alpha can do the opposite, right? So that's why, we call it one can design an covered call strategy where I would buy the stock and buy this option, and we have run our analysis. It can generate as much as 20% annualized return over the period where the stock market was making around 15%. So that is the alpha, or the classic structural alpha that one could have collected if one had applied that strategy over last 10 years. And going forward, the investor demand for yield is not going to go away. There's no new supply, there's no demand for options coming which will fill the gap, so to say. So, or at least some investors would get into the other side. So maybe over next 10 years, the effect won't be that pronounced, but still there is likely to be alpha opportunities over some time to come till this demand supply imbalance matches out.
So as part of that supply demand imbalance, the fact that, people think there's this idea like I'll just sell covered, I sell covered calls, and they do it in a systematic way, but all of a sudden it becomes trendy. And now, what'd you say it was over $90 billion in those covered call funds? And those are just maybe the most popular, but there's certainly a lot out there in addition to those. And at the end of the day, there's still a market of supply and demand. It's not infinitely scalable, right? So as more of the calls get sold into the market, I believe that has like a volatility, a damping effect, because you're really buying and selling amongst other Greeks. But if you try to isolate it down, initially you're selling like the implied volatility, right? And so if there's more supply of implied volatility coming to the market, it dampens the demand isn't there to absorb it, and so the price essentially of the implied volatility drops, and that's what you're saying. Sort of, it gets so cheap because so many people are trying to sell it that it's offering this opportunity to.
It's like a cycle. It's like an insurance company in reverse, in the sense that, when the market makers are buying these options, if they find they're not able to make money of that, then in the next cycle, they will offer even lower price, and so on and so forth, so to say, right? So, basically, ultimately, the flows have to be met somewhere, where if only the market makers are meeting those flows, then obviously they will charge, unless there is another group of investors, which stand in the other way. We are happy, even if it is not 5-6% of performance, even 2-3% is enough. So then the market kind of balances, in a way that if there is no flow on the opposite direction, then obviously there's a big drag on the covered call strategies, which constrain the growth of that market. So once the market matures, there is enough players on the other side, then both sides can grow, so to say.
Okay, so in order for this, so if I understand what you're saying, is essentially this is a structural edge that exists and is observable. However, structural edges are long and persistent, but they won't always necessarily be there. So if enough people started, crowding the other side of the trade, so to speak, then you would come back to just essentially market neutral, And in theory, if it was a neutral market and all you did was buy or sell calls on the options expiration day or whatever, you would essentially all you would lose is the premium that the dealers are making, right? And both sides would lose that premium, right? Like or essentially that commission that the dealers are making in the middle. And so if you even take the dealer out, essentially you're just saying like you could run the strategy from either side and it would be net zero. Like there is no gain or loss to be made.
Right. So, I mean, I would say that instead of getting balanced, even if it gets to 2:1 kind of a thing,
Mm-hmm.
then okay, there is more demand for yield, and there is some supply, from or more supply from the yield investors, and there's some demand from alpha investors. And I'd say something around 2:1, the market kind of stabilizes. There's some risk premium, and so on and so forth. Firstly,
Okay.
I mean, a much more dynamic environment one can actually see in something like a VIX market. You remember the days 2016, 2017. VIX curve was giving a lot of premium. The strategy became very popular, so much so that the dynamic flipped. That insurance demand from VIX became they turned into investors shorting VIX becoming lot more popular, and which turned into a XIV kind of 2008 event. Since then, the market has stabilized, and big strategy was very good after COVID, but became all the juice had been sucked out. The demand supply kind of balanced last year, but again after tariff tantrums, there is more risk premium available in the VIX market.
Is that from effect? Like a lot of times people talk about the VIX and they're really quoting like the forward month, and so does the observation really come from looking at the further out in the curve? So when you have something like the tariff tantrum, it increases the risk premium available across the entire curve, and so longer dated options provide you the opportunity set to take advantage of the structural nature, or essentially providing juice to the potential trade, right?
So in terms of trading VIX, there are two factors one need to look into. One is just the level of the VIX. Obviously, if you're looking to short, higher the better. But at the same time, the roll effect. So let me show you another chart where I will compare current VIX curve with what we saw over last year. Is that So in this, we see the brown line is the average VIX curve over 2024. And earlier this week, this was the black was the shape of the VIX curve. So you see the
Mm-hmm.
VIX is not only higher, but also steeper. So there's more potential for VIX to go down. And if it doesn't go down, just the roll down adds to the yield. So, the combine both of them together, VIX is a lot more attractive as compared to last year. And, this is effectively that a lot of people who were shorting VIX got burnt out after the tariff tantrums. And now the risk premium has, it favors more towards shorting VIX. There's more demand to hedge the uncertainties in the market as compared to the investors are willing to collect that on the other side by shorting VIX. So
So
that,
in other words, if you went into the year saying I'm going to short vol, and you kept shorting volatility, in March, and then all of a sudden April happens, and VIX has a historic spike, you absolutely get your face ripped off in a volatility spike, and your short volatility. Basically, you just got rinsed out of the market, and now they're not there to sell. The volatility so aggressive because it takes a very irrational person to get completely rinsed and then say, "Well, back at it."
so yeah,
The human psychology doesn't really
right.
allow for
So
that,
that's why
on a
VIX is
natural
a
basis.
tricky, like tricky. VIX is a tricky product that over long horizons, both long VIX strategies and the short VIX, both sides lose money. So the trick question becomes who makes money, right? So the trick in making money in VIX to have a very small exposure. That before the tariff tantrum, we had only like 10-15% of VIX exposure, while our fund maximum exposure goes to only 30-35%, so to say, right? So as compared to the VIX products, which had a big drawdown, you have 50 to 75% or even 100% exposure as compared to that. If you own a VIX strategy, make sure the exposure needs to be small enough.
Well, I think that's always a good fundamental portfolio construction principle, right? Which is managed position sizing. And I've come to learn personally, I think that's almost more important than managing the direct position, right? You can almost get the wrong asset, but if you position size it correctly, you still get a decent outcome. But you can certainly pick the right asset, position size it wrong, and get, just annihilated. And before you ever get to the end result that you had a thesis or conviction on, right?
Yeah.
So
I would also like to give a little bit of historical background to structural alpha.
yeah,
The
for sure.
origin is in bond market. The legendary bond investor, the bond king, Bill Gross, who originated this term. And what he found that the interest rate derivatives have a very small but persistent structural alpha coming from the mortgage market, right? So most of us have a mortgage where we have a prepayment option, right? So we have bought that optionality or convexity on the interest rate, and for that we pay a premium. That premium get percolated onto the interest rate markets such that the interest rate options actually trade rich. While the equity options are trading cheap, interest rate options trade rich. That's why by taking mortgage exposure as compared to mortgage securities exposure as compared to treasuries, one can pick up extra yield, and one can structure the even the treasury exposure overlaying options. One can enhance the yield of treasury positions without increasing the credit risk. So that is a very, very persistent structural alpha component, as compared to what we saw. Then VIX can flip every year, while covered call strategy could be a 5-year kind of a cycle. But structural alpha in bonds are very, very persistent, and that can help improve the yield of a bond portfolio without increasing the credit risk. You know, so if you increase the credit risk, then there's just a beta exposure, right? So if you can increase the yield without increasing credit risk, that is a true alpha exposure, so alpha experience, alpha output, so to say, outperformance.
Okay. That's interesting. So, why, help me understand why the options trade rich. And so when you say that, you're saying the structural alpha side, if the options are trading rich, you want to be the seller of options. That's where you get the premium, right?
Yep.
So why are they rich? What's the
Right.
fundamental forces that's creating that edge?
Right. So basically, as I mentioned, so homeowner takes out a mortgage, pays a premium. So banks own that mortgage, own those mortgages. So now banks have to hedge their interest rate risk. To hedge that risk, they would buy treasury options.
Well, and
Right?
they have to hedge a risk because of that prepayment option, is what you're saying, right? So
Exactly.
the ability of us as homeowners, that if interest rates go down, I'm not saying, I had a 7% mortgage. It sucks that mortgages are at 4 now. I can just, I'm stuck at 7. You just say, well, here's all your money back, Mr. Banker, and I would like a 4% mortgage.
Right.
And so the banker got the raw end of the deal on that because, he just got paid back when his reinvestment is now going to be at 4%. And he was thinking he was getting 7 for 28 more years.
Right. So from a bank's point of view, they have issued a loan, but they don't know when it is going to get paid. So effectively, the duration is very, flexible or a function of interest rates. If the interest rates go up, the duration increases. Interest rates go down, the duration, reduces. So that creates a lot of negative convexity, which we saw the SVB crisis, right? So, suddenly the interest rate go up, and banks who do not hedge that risk try to capture all of the spread from the mortgages, get nicked, the mark-to-market losses on their bond portfolio, so to say, right? So banks, should usually don't leave that risk unhedged, and they hedge it using the treasury options. So the treasury options in the market themselves trade at a higher volatility than fair value. So by structuring a portfolio of, short treasury options alongside a bond portfolio can, improve the yield of the portfolio.
And that's sort of, and the reason that is because banks are the marginal lenders of the money for mortgages, right? So like I don't have a lot of need to hedge my interest rate risk on mortgages as a small investor, right? Whereas banks do. And so that's where I guess that's what you're identifying is that's where the structural side of the alpha comes from is like banks will sort of structurally always be the bigger marginal lenders of mortgages and have that kind of risk on their books than, 401k plans or whatever, right? Or, just individuals. And so we don't have the need to go to the market and sell those options normally. So if you are the person that identifies that supply and demand imbalance, it affords you the opportunity to go and say, all right, if you're paying up, I'm here. A lot of people don't know that it exists, but I see it and I'm here and I'm happy to take your money. How do you keep though from just getting your face ripped off if it goes against you though, right? Because now you're short, short a naked call.
So we are talking about the bond market, right?
Yeah.
So, so as compared to equity market, in a bond market, 5% is called face rip off kind of a thing. And that's what we
Well,
saw.
yeah. Well, I mean, the leverage involved, right? Yeah, it's definitely not the VIX complex. But I guess what I'm saying is like, interest rates, they're kind of, they're boring and sleepy until the one day that all of a sudden there's a global pandemic and all of a sudden interest rates get really interesting really quick,
So it's just a matter of risk spectrum. VIX is very high risk, high return. Then, equity market is a normal level of risk return. And bonds are on a much lower spectrum on the risk, the risk
Mhm.
profile, so to say, right?
Yeah.
So, in that context, even a 1 to 2% outperformance of the benchmark over long horizons is very good value. So, think about it this way. If you are outperforming the benchmark by 150 basis points over 10 years, and once in 10 or 20 years you lose 5%, so on an average it's a good trade, right?
Yeah. Yeah. Well, they say about averages, right? What do they say? Your face can be in the oven, your feet are in the freezer, and on average, you're feeling okay.
Right. So, I mean, yeah. So definitely, one has to see the environment that's where you would need an active manager to construct the portfolio in such a way that with the changing market environment, you avoid, at least the known unknowns, but minimize the damage for an unknown unknown as much
Yeah.
as you
Yeah. Well, I think one of the most interesting things that, ETFs have done for finance in general is democratize these type of ideas, right? So,
can.
this is a really interesting conversation. And I think if we had it, if we had this conversation 10, 15 years ago, it might as well not leave the halls of PIMCO because no one else would be able to put the trade on, right?
Yeah. So I mean that
And
sorry to interrupt, but I think that reminds me that structural alpha, I believe, has a very good niche in the ETF market in the sense that structural alpha is part of the active management, right? But
yeah.
typically active management and ETFs don't go well together. The active manager would not want world to see what their positions are on a daily basis, so
Hmm.
to say, right? While structural alpha is an active strategy delivering active like alpha, but it's a very, very passive strategy. It's against a known structure like the covered call strategy that we saw. So it is, for passive investors into passive ETFs can consider, shifting
Hmm.
some of the exposure to an actively managed strategy, which is very, very passive
Yeah.
from a known structure that alpha, everybody's looking for outperformance, right? So if you can, you know, get a very passive strategy or active strategy being run very passively just because of the structure of the market,
Yeah.
it can be a good, uh, you know, uh, product mix from the ETF point of view.
Yeah. One of the things that I've found really interesting about if we go back to the covered call conversation and talking with people about it, and there's not a shortage of financial advisors out there. Obviously, I deal primarily with the retail investor and, the general public. So I talked to a lot of other just regular financial advisors, and they love these covered call strategies. And it's because you're like, oh man, you can show up there's a yield, you can show up there's income. And hey, it's like if the market goes down, you've got some downside protection, because if you got paid 1% on the premium and the market goes down 5%, you're only down 4 because you got some premium, right? And I, I just had, sometimes the blessing and the curse of growing up around the industry. And so I pretty vividly remember a lot of the happenings of the dot-com era in 2008, and was maybe a little bit more front row than, a lot of younger financial advisors. And so I remember what some of these really nasty markets look like. And I go, yeah, well, when it gets to be the point that, you say, well, the market's down, 50, but you're feeling really great because you're only down 48, all of a sudden your covered call is not doing you much justice. And the problem is that you're keeping so much of the downside risk because you own the underlying asset in these strategies. And so once you burn through the buffer provided by the call premium, right, you still own the downside beta. And what you're demonstrating in your work is that structurally they're underperforming on the upside. So even when you have the exogenous shocks and the ride feels a little smoother, all you would be doing is sort of giving back some of your
Right. So
normal gain that you would have gotten on the upside, right, had you not sold it away.
Right.
I find it really interesting, but I don't think there's any shortage out there of interest
Yeah, I mean,
in the space still. So
not to beat up on the covered call strategy. I mean, there is an investor need for that, and there will be certain environment. Like if there is a market downturn like 2022, then covered call strategies help,
yeah, well, yeah,
But if
because
it is
it's
if it is a
slower bleed
COVID
out on the
type,
downside and
right,
constant income.
right. So, but it's a COVID kind of a situation, then it helps by only 2% in a month, but it loses out on the swing back, so to say. So I
Yeah,
would
yeah,
say once in 10 years, covered calls will be a good strategy, but
yeah.
usually probably not.
Well, and I think that's why it's called structure alpha. It's not called, structural daily outperformance, right?
Right. Exactly.
Yeah. uh, so anyways, yeah, you know what, and I don't want to dog on the strategy, the covered call idea too much either, because candidly, I love that people keep selling them into the market and suppressing the volatility. So,
Yes.
if you're
I
listening to
mean,
this episode and you're a covered call person, rock on.
yeah. I mean, as I said, some investors have a preference. There's a lot of psychology goes into investing, right? So,
Yeah.
every month getting a fixed amount of paycheck has certain value.
Yeah, yeah. No, that's true. And it's always, two different people with two different objectives is what makes a market.
Exactly.
So, but what I was the knock on of what I was thinking on the other side of the sort of the anti-covered call idea is if you get the structure outperformance, you sort of can position size down your equity exposure now and be more
Exactly. I
capital
mean,
efficient in a portfolio, right?
yeah, if you
And
have a significant alpha, I mean, you can reduce your beta risk. So you can
yeah,
actually, achieve lower than market risk and higher than market return, which is the holy grail of investing.
yeah. Provided somewhat systematically and structurally. That's yeah, it's a compelling and interesting idea. I'm sure a lot of research goes into the management of
Right.
those ideas. So
Another
people got to
word
do
for,
that. But
yeah. So we put it under umbrella of upside convexity. Check that out on our website,
sure,
simplified.us. So, very simple strategy to securities in the fund, and one can capture what others are paying up.
yeah, yeah. Well, Shailesh, I appreciate you coming on and sharing some of your insight and guidance with us. Obviously, that's not something that somebody wakes up in the morning and just figures out what structural alpha is. I'm sure that came with a grueling career early on with a lot of research and probably a lot of painful lessons along the way.
Yeah,
Um,
and we should not stop this before thanking legendary investor Bill Gross for the structural idea concept.
yeah, well, shout him out, and I will have to go look more into his work. I wish I could say I was familiar with Bill Gross, and I'm not. So pardon my ignorance on that, but now you certainly have me intrigued.
Okay.
So Well, Shailesh, thanks again. And I look forward to catching up with you soon.
Okay, thanks, Brandon.
Take care.